Well, it is great to be back in the studio after I've been away for almost 3 weeks, where I've been visiting a lot of my clients in the UK. And if any of my clients are watching, a huge thank you for your kind hospitality. And I'm not going to easily forget all the posh coffee and even posher biscuits. Today we're going to be exploring the frustrating but all too confusing subject of pension consolidation. But before we get into that, in our previous video on Flexi Access Drawdown, one of the viewers, James, did get in contact with us and asked us the following question. How do people generally take their drawdown money? For example, is it monthly or do they normally take lump sums to cover 12 months of expenditure? Well, the short answer is a flexible pension is going to allow you to control how you decide how to take your money and your withdrawals. But not all pension schemes are created equally. So you need to check with your provider to find out what options are open to you. So a pension is designed to provide you with a replacement income when you stop work. So for most people, they're going to prefer to set up an automated monthly payment to meet their monthly regular bills. So make sure you understand the effect of taking monthly withdrawals from your pension and how long the pension could last for based on the level of those withdrawals. And this will make sure that you don't overspend, particularly in the early years. Now remember that the personal allowance is £12,570 and that has been frozen until April 2028. But any income above that is going to be taxable at your highest rate. So you also mentioned whether people take a lump sum to cover a year of expenditure. Well, this is definitely going to help create a very healthy emergency fund. And it's also going to allow you to kind of forget some of the noise around your fund value rising and falling, particularly in the short term. So if you are going to be using a taxable lump sum for this, be very careful about the amount of income tax you're going to have to pay, as that could be a very expensive way to get a robust emergency fund. Now, if you are concerned about the investment risk, look into providing a secure and guaranteed income via an annuity. Now, I'm going to post links for both the Flexi Access Drawdown video as well as the annuity video in the description below. I hope that helps, James, but if not, please drop me a comment and I'm more than happy to discuss this further with you. So should you consolidate your deferred pensions or not? Well, I'm going to highlight some of the benefits, the potential drawbacks, some pitfalls to avoid, and how these can all impact on your overall retirement plan. So whether you're juggling multiple pension pots, trying to trace lost pensions, or just considering simplifying your finances, this video is going to guide you through everything that you need to know. Now, welcome back to the channel, and if this is your first time, a very warm welcome to the Economies channel, where together we're going to be learning the language of money and wealth. And in this channel, we're also dedicated to mastering money and making financial wisdom available to all. So hi, my name is Simon and I'm a chartered financial planner here in the UK. So before we start, I'm going to pop up the usual disclaimer to state that this video is for education and entertainment purposes only and shouldn't be misconstrued or misunderstood as offering financial advice. So how many times have you been faced with a ridiculous amount of paperwork from your pension provider and all you can see are numbers that you don't understand and words that don't make any sense? Well, we've all been there. And today I'm going to try and help you make sense of all of that. So don't panic, stay patient, and let's see if we can help solve this problem for you. Now, by now, you'll know that we love a famous quote on this channel, and I've got two for you this week, and both are from the absolutely formidable Bruce Lee. Number one, absorb what is useful and discard what is not. And his second quote is simplicity is the last step of art. So what is pension consolidation? Well, pension consolidation involves combining several pension pots into one. Now, this might seem simple, but it can have significant implications both for you, your financial health, and your financial retirement comfort. Now, on average, individuals in the UK, they change jobs about 12 times during their working life. And thanks to auto-enrolment, a further 10 million employees have started new workplace pensions since 2012. So if you do change jobs throughout your career, leaving behind small pension pots from your previous employers, or you might even have personal pensions scattered around, you can consolidate these deferred pensions either into your current workplace pension scheme or a personal pension to simplify your overall retirement strategy. So before we get into the advantages and the disadvantages, I want to explain how pensions have changed over the years so you've got a better understanding of some of the benefits that you might not be aware of but are definitely worth checking before you move forward. Now, I always explain to my clients that not all pensions are created equal and the devil is most definitely in the detail. Now, important changes to the pensions landscape happened in 1988 when personal pensions were created. But what options did you have before that? Well, retirement plans were available before 1988 and they were for those who didn't have a workplace pension scheme or were self-employed. Now, you could get tax relief on your contributions and there was an element of investment control, but absolutely nothing like today. Now, typically the retirement age was between 60 and 75 years old, and they sometimes came with guaranteed annuity rates, which were very attractive, and they provide an income which is far higher than you could ever achieve today on the open market. However, with some of these old schemes, the fees and charges could be quite high, and the withdrawal options were fairly limited, and they were also seen as quite complicated, so the take-up was not as high as was needed to provide a dignified standard of living in retirement. So what changed in 1988? Well, personal pensions were introduced and they had incentives for people to save for their retirement. These pensions could follow the member between jobs to allow for an evolving employment pattern, and that meant these people would not be as dependent on the state pension. But this was not without controversy. Now, people now had to make their own decisions which needed a level of more financial literacy, and this meant that many people were transferred out of more secure pensions into personal pensions, and this created a mis-selling scandal, the shadow of which still remains over our profession to this day. But it did allow people to take greater control of their retirement planning, and this changed the pension landscape forever. Another important date was April 2006, which we call A-Day. This is a significant date in the UK pensions industry, marking the start of what was called the pension simplification regime. And the idea was supposed to streamline some of the complex rules around the various pension schemes and to encourage even more people to save for their retirement. So, quick question, how do you think that's working out for everybody? And now people could take a 25% tax-free cash lump sum from their pension from age 55. Now, be aware that this is changing to age 57 in April 2028. And this is going to affect anybody who was born after April 1971. There was also the introduction of a lifetime allowance, and that was created at 1.5 million. It also created the annual allowance, and that's the maximum amount you could contribute into your pension in any tax year. That stood at, now wait for it, £215,000 in any tax year, and that was 18 years ago. There are also more complicated pensions created, which allowed the purchase of commercial property as an investment as well. Flexible drawdown was allowed if you had a secure and guaranteed minimum income requirement of £20,000 per year. Now, all this represented a huge shift in government policy for people to take more responsibility for their own retirement. And if you are finding this video helpful or useful, please give it a thumbs up, hit the like button and subscribe to the channel. So what do you do if you've lost your pension details due to changing employment or even moving house? Now, here's a quick fact for you. There are currently 1.6 million pensions unclaimed or lying dormant, worth an approximate £37 billion. Now, if you do the quick math on that, that's worth about £23,000 per pension, where you can use the government tracing service to find the contact details or at least search for one of your lost pensions. Now, you will be able to find the contact details for an old workplace pension scheme or an old personal pension scheme, but you will need the name of your employer or your old pension provider to allow you to use this service. Now, incredibly, less than 5% of us notify their pension provider when they move house. Absolutely incredible. Now, if you have contracted out of SERPs, you may find that you've got a pension scattered somewhere. So what you can do is give your national insurance number to the HMRC, and they're going to be able to tell you if you were actually contracted out and then help you trace that provider. Now, I'm going to leave a link to the government pension tracing service in the description below. So let's talk about some of the advantages of pension consolidation. So by consolidating your pension into one pot of money, you're going to be able to ease the burden of administration, which is going to make your life easier, as you're not going to have to deal with that many pension providers who are going to keep you on hold for an hour, ask you 20 questions just to change your address. They're going to send you statements or feel like they've been written in a foreign language. And the government wonders why there's so much apathy and lack of engagement with personal pensions. And if you are going to consider a transfer, it might be worth considering a pension provider who's got a portal or a platform which is likely to give you more control and the ability to change all your personal details online. Now, by consolidating your pensions, you are going to be able to reduce the hassle of keeping track of multiple pots of money, various investment funds, of course, their performance as well. But charges levied by pension plans are also very important to consider. Now, consolidating your pensions could mean eliminating some of the higher charging plans, especially if you've got an older plan, in favour of some of the more modern, lower cost options. Now, some pensions have got better investment options than others, so consolidating your pensions could help you get rid of some of the underperforming funds. Now, a better performing fund, or one with much lower costs, should provide you with a much higher pension fund value at retirement. I'm going to explain the differences in this chart on screen. So if we look at pension A, we've got a starting value of £10,000, and the performance, because it's an old style fund, has been 4% per year. Now, the charges are 2% a year. Now, if you project this performance out to 30 years, the end value is likely to be £18,114. Now, if you wanted to consolidate into another pension, let's use the same starting value of £10,000. Now, because they've got a greater range of funds, the overall performance will be 6% a year. And because it's a modern pension, the charges are lower at 1.5% a year. So let's project that forward for the same 30 years, and this pension will have an end value of £37,453. Now, that's over double the value, and that is most definitely worth considering, and that can have a significant impact on your retirement plan. Now, if you are going to be selecting your own fund from a larger range of fund, make sure you pick one that matches your risk tolerance to meet your goals and, of course, your time horizon. Now, having greater flexibility to access your pension, as well as the timing of the withdrawals and the shape of the income, is also incredibly important. Now, some older plans lack the options and the choices to match the income you want to withdraw in retirement. So, for example, you might be looking for a blend of tax-free cash and taxable income to be paid monthly, as well as taking ad hoc lump sums from time to time. So let's have a look at some of the disadvantages of pension consolidation. Now, as I said earlier in my reply to James, not all pensions are created equal, and the number one overarching rule here is as follows: the scheme rules rule. Now, some older plans have protected tax-free cash, and I've seen cases where the tax-free cash was 100% of the fund. Yeah, you heard that right, 100%. So the whole fund can be taken as a tax-free lump sum, and this valuable benefit would be lost on transfer. In addition, some of the older pension schemes have got guaranteed annuity rates, some as high as 15%, and that is a lot higher than you can obtain today on the open market. And again, these incredible benefits will be lost on transfer. Now, some pensions which were invested in a with profits fund may include a terminal bonus, which also could be lost on transfer. And some of these older pensions, they can also apply some very hefty exit penalties as well. So it's not always just a simple case of consolidating your pensions, but if you're sure that you are not losing any valuable benefits because of the transfer, then consolidating your pensions could make a significant difference to your overall fund value at retirement. I mean, after all, this is your money, this is your pension, this is your retirement, and it's your standard of living that we're talking about here. I do get a lot of clients saying that they've got pensions with low values and these aren't going to move the needle on their standard of living in retirement. So let's talk briefly about small pension pots. Now, the triviality rules allow some defined benefit or final salary schemes to fully encash their pension if the cash equivalent is £30,000 or less and they are 55 years old. For defined contribution pensions, which most of us have, you can fully encash your small pension pot and 25% will be tax-free and the rest will be taxable. Now, nearly 740,000 pension schemes were accessed in the 2022-2023 tax year, and that was up about 5% from the year before. Now, 56% of these pensions are being encashed in full because the majority of them are £10,000 or less, and this is according to the latest data from the Financial Conduct Authority. So I'm going to put a chart on screen right now and walk you through some of the details and explain how this works. Now, what I'd like to do is focus on the grey bars in these charts, and that's the percentage of people who are not taking financial advice. You can see from this chart that about 60% of the people are not taking advice when it comes to buying an annuity, and that is despite all the recent changes in the annuity market and all the guarantees that are available. More worryingly, there is a steady increase in the percentage of people who are flexibly withdrawing their pensions or fully encashing their pensions without taking professional advice. And this is a very big concern for both the Financial Conduct Authority and potentially for your retirement as well. So if you do flexibly access one of your pensions, you're going to have to notify all your other pension providers within 90 days or face a penalty of up to £3,000. So please make sure you know exactly what you're doing before you access your pensions. Now remember, you can nominate any beneficiary to receive any of your unused pensions on death. So make sure that your nominations are up to date, especially if your family circumstances have changed since you took out the original pension. So what do you do next? So if you're considering a pension consolidation exercise, you need to start by getting a detailed overview of all of your deferred pension schemes. You need to look for any guaranteed benefits, look for any exit penalties, the range of funds that are open to you, the fees and charges, and of course any long-term investment performance, as well as understanding any tax implications of accessing your pensions. So in conclusion, now every financial decision should be based on your specific circumstances. And whilst a pension consolidation exercise may seem attractive to have all your pensions under one roof and of course under your control, you need to make sure that the positives outweigh the negatives as part of a structured retirement plan. Now, if you found value in this video, please hit the like button as well as a notification bell, as well as subscribing to the channel so you don't miss any valuable future content. Now, it's worthwhile mentioning that about 85% of the people watching these videos have not subscribed to the channel as yet. So please help me get this financial wisdom to as wide an audience as possible. And finally, this is your channel and this is your voice. So if you've had a positive experience or even a negative experience about your pension consolidation experiences, then please let me know in the comments below and we're going to all learn together. Thank you so much for your time as well as for your patience. I've really enjoyed this and we'll see you all again next week.